During the global financial crisis, when I think you started with us back in '08, you had major problems with mortgage lending. And regulators' response when the crisis began to subside was significant regulation, making it very, very hard to extend credit in an irresponsible fashion. That's in contrast to some of the issues that we're seeing on the underwriting side in unsecured corporate credit that made it through the global financial crisis relatively unscathed. It's been years of very, very strong fundamental performance because of this conservatism, both in terms of home building as well as credit extension. There's a tremendous amount of equity trapped in the home. That's great as a lender. So we see this as one of the most attractive absolute and relative value opportunities in the market, and we have deep resources here.
As policy rates rose across the world, consumers benefited from having opted into a 30-year fixed rate loan at 3.5%. And so that created a very unique dynamic for the U.S. consumer. As rates rose, that largest liability that they had on their balance sheet, right, the cost of that fund didn't rise at all. And that, as income rose, that created additional lending opportunities into the consumer debt markets. The other kind of long-term impact that we've seen from the long-term locked-in rate is a reluctance to give up that liability. That liability, in some sense, is an asset. That's created an environment where lending into the second lien market is starting to evolve. It's starting to become an option for consumers because, again, as a refinance tool for credit cards or auto loans or the type of consumer debt that comes at typically double-digit type yields, having the opportunity to cash out some of the equity in your home can bring down that consumer's overall monthly payment obligations, which will lead to an even healthier consumer if the economy slows or if the economy starts to weaken.
I think the second important theme to note is the public policy focus on housing affordability. This should create significant performance tailwinds and opportunity. A recent example is the federal housing agencies deciding to acquire mortgage collateral, on the order of a couple $100 billion, at least in the base case. So I think it's always important to pair, the more quantitative type data analysis, risk management systems with an appreciation for the policy uncertainty. And over the multiple decades we've operated in these markets, we've certainly seen, a lot of policy twists and turns.
Generally speaking, I think we would find the opportunity to invest in seasoned mortgage credit to be, even more compelling today. You're buying loans that would generally trade at a discount. They were originated in a different interest rate environment. So those low coupon mortgages come at a dollar price that's generally below par, not because it's a reflection of weak credit, but because prevailing rates are just a lot higher. That eliminates some convexity risk, creates some longer duration type profiles that maybe are not the best asset for other investors. It's a little bit more a narrow focused investor base. So all those opportunities create an environment where we could pick up spread or returns and still be a little bit more defensive at a time when the go forward outlook is more uncertain.